Okay, we're live. How you doing, friends? This is Coach Ernie, and this is the 0 Days to Expiration podcast. Every Monday, Tuesday, and Wednesday, we do this live and go over another aspect of zero DTE trading from an extreme asymmetric point of view, risk to reward, and looking for convexity. If you don't understand what convexity is, go back on any of our previous podcast episodes, and I'm sure you'll catch a whiff of it somewhere. We'll talk about it as well today. And it's going to be a central theme in today's podcast, today's show, as we talk about the various zero DTE ways to trade that you may have already come across. And I will show you the pluses and minuses of each of those different ways and then compare it to the way we actually trade and show you the efficacy of our methodology. And one thing that, this is a spoiler alert, you're going to find that there is an extreme difference between the way everybody else trades zero DTE from a retail point of view and the way we trade zero DTE more from a professional options trader's point of view. Okay, a little Death Wish coffee first. Now I'm ready to go. So by the way, when I do these presentations, I do a PowerPoint and I'll show you the presentation. That will be available as a link in the description after the show. I don't actually have it in there right now, but this presentation, I'll make it available as a link. And you can go back to all the other shows and download that presentation. Sometimes I also have accompanying supporting documentation or links to tools and that sort of thing. And so make sure you do that. The other thing is that if you are here and you are watching this show, which I'm not sure anybody is actually right now, because otherwise I would see people here. So I have to make sure that we are, we have 25 people watching right now. That's good. I was afraid that I had this unlisted again. I made the mistake earlier in the week to have them unlisted. So normally, like I said, we do this Monday, Tuesday, Wednesday, but because of the holiday week and Monday was a holiday, I switched it to Wednesday, Thursday, Friday. Next week, we'll resume Monday, Tuesday, Wednesday. By the way, if there's any particular topic that you would ever like me to cover in one of these episodes, let me know. Put it in the comments, whether it's live or whatever. All right. Anun, thank you very much. He's online. I know that there are at least 25 people here. If you do have comments during the show, put them into the live comment section, and I'll try to answer all your questions. So, what is the best way to trade 0 days to expiration options? Let me first say that we focus primarily on index options, specifically the SPX or the NDX. And we'll even trade the XSP, which is 1/10 the size. It's the micro version of the SPX. But you can also trade stocks. And in fact, I trade stocks with this using things like Tesla or Apple or Google or any of those big 7 stocks are definitely candidates. And soon you're going to find that they will have, but right now they only have 1 expiration per week, but very soon you're going to see them pop up with 3 expirations per week. So I'll be talking about those stocks as well in this conversation. But right now we trade primarily the index. So all the examples and everything that I show are using the SPX options that expire 5 days a week. Okay? So we got that out of the way. Coach, is it always the same link for Monday through Wednesday? No, it always shows up in my YouTube channel, right? So it'll be right there. The 3 shows on Monday, you'll see them right there. And you can set a notification so that when they come up, but they're always at the same time at 9:15 a.m. All right. So if you like this content, give it a thumbs up, subscribe, and share it with your friends. Yes, IB definitely shows multiple days to expire on SPX, right? He's referring to Interactive Broker. But all options platforms will show you when those days are, when their expiration dates. But just so you know, the SPX, the NDX, the XSP, the index on the Russell, they all show 5-day expirations. There are, also some ETFs like the SPY ETF will also show 5 days of expirations. And there are some futures contracts that will also show 5 days of expirations, including the E-mini S&P futures, which is the ES or the NQ, and even CL oil will show 5 days expirations, and that's a lot of fun to trade with 0DTE, and also gold, GC, gold futures. So there you go. There's all kinds of things that you can trade using this methodology. Coach Ernie, I am interested in learning more about the nuances of trading 0D out-of-the-money flies on ES as opposed to the SPX. For example, rollover, assignment aspects. I will never talk about rollover, and I can explain that at some time in the future. But rollover is not part of our strategy. But I will show you numerous nuances that you can get into and how to optimize your trading. And the ES is essentially the same as the SPX. They are both European-style options, meaning that there's no assignment until after expiration. With the ES, you can get assigned a futures contract. With the SPX, there is nothing to get assigned, so it's cash settled. So other than that, the main differences are the size and the cost of an ES option. An ES butterfly is going to round trip cost you about $21 with commissions and fees, where the SPX will cost you about $9 round trip. The other thing that you need to look out for on the ES is it is a quarterly expiring future. So there are going to be differences in pricing and so forth, and also things that you have to worry about on rollover of the ES contract. So those are some things that you need to take into consideration. The ES also has a 50 times multiplier, meaning, and the SPX has a 100 times multiplier, meaning that the ES is about half the size. So it's half the size, 3 times the cost. In other words, the ES is actually about 6 times the cost of the SPX for putting on an equivalent trade. So keep that in mind. The one thing the ES does have that the SPX doesn't is it has volume. So we, in fact, use the ES to look at the volume profile so that when we're doing SPX trades, we use the volume profile of the ES to determine where our structural levels are. And we use that as part of our entry event mechanism. So we do use the ES as well, and I trade the ES. Okay, now we've gotten all of that stuff out of the way. All right. Hey, Christian, how you doing? And everyone's showing up now. Again, give this video a thumbs up. Really appreciate it. We're going to get back. We're going to go to the presentation now. Here we go. Again, we're talking about the best 0DTE strategies. All right. I want to show this. There you go. Need to make it a little bit bigger, fill up the screen. Cool. The best way to trade 0DTE. There are dozens of ways to trade 0DTE options, that's for sure. One of them actually has the math on its side, and that's what you're going to learn today. Now, let me just say directly, I'm going to show you a bunch of strategies, and this is not opinion-oriented stuff that I'm giving you. I'm going to show you why our way of trading is objectively better and more sane and has true efficacy, long-term viability over all the other ways that people trade 0DTE. It's really what the math reveals. It is the truth. Okay? So I'm going to put all of these into what I call categories, and you can see that there's some that you would consider a lotto call, credit spreads, iron condors, naked options, gamma scalping. Gamma scalping, a lot of people make some hay over that. It's one of the ways that institutions trade. It is completely off the table, at least the way the institutions trade for a retail trader. I do have my own version of gamma scalping, which is actually quite good. That's based on our out-of-the-money butterfly methodology, which is very good. But the gamma scalping I'll be talking about today is really what is well known out there as the institutional way of doing gamma scalping. The lotto calls, that's simply putting an out-of-the-money way out of the money long call or long put. As a zero DTE trade, it is really, that's exactly what it is. You're looking for 2 sigma or better moves, and they don't happen very often. They're like generational trades, or they might happen a few times a year. So that way is kind of... Anyways, let me get into all the individuals. So the 5 criteria that I'm going to look at all of these different strategies is looking whether or not it has defined risk. That's an important consideration. Has an asymmetric payoff. Can you execute? Is this rules-based? Is it something that you can do in any kind of market? Does it matter if the volatility is high or low? Are we bullish or bearish? Is it something that you can have very objective criteria for trading in all these different types of regimes, particularly the volatility regime, which is really, from an options trader's point of view, that is the number one criteria for us. And is it scalable? What do I mean by scalable? I mean that what is its distribution of returns? Does it allow me to incrementally increase my risk and allow me to get much larger profit potential? That's really the only way that you're going to scale. If you have a strategy that requires a huge amount of risk to get a small bit of profit, that's going to be extremely difficult to scale. All right, so keep that in mind too. All right, so let's look at the first one, lotto calls. Out of the money long calls, you can buy them cheap on the day of expiration and hope for some kind of explosion in price. And yes, you can get into them small, so they do have defined risk and there is an asymmetric payoff. But the decay is really a problem, and really depending on what kind of volatility regime you're in. For example, if you're in a very high volatility regime, those options are going to be relatively expensive, and that's because the premium has been delayed in its decay, or in other words, the options have become bloated. These are better if you're looking at low volatility. You can get into them super cheap, but the thing is, with low volatility, the chances of them exploding are much less than in a high volatility environment. So it's very difficult to put these on in terms of rules in the volatility regime. They're really situational to put on. For zero DTE, I wouldn't recommend it. For longer dated options, maybe 30, 60 days out, and use it as a portfolio insurance type of mechanism, long dated options are great. But for zero DTE, not so great, and it's not scalable. All right, there's the market. Let's go on to credit spreads. Everyone's favorite, credit spreads. Does it have defined risk? Yes, it absolutely does have defined risk. Does it have an asymmetric payoff? Sorry, I still have this lingering cold. Does it have an asymmetric payoff? No. Typically, when you're putting on a credit spread, you're looking at maybe a 3-part risk, 1-part return. Some of them you might look at a 1-to-1, but most people are looking to put them on with a 20 delta or a 10 delta. So that means that it's 70% part risk, 30% part potential profit, or a 20 delta is actually 80-20. A 10 delta is like a 90% probability of profit. But you're putting on huge amount of risk in order to get that payoff, and it's certainly not asymmetric. It's asymmetric, but it's in the wrong direction. And are they rules executable? Sure, if you're paying attention to volatility regimes. Most people don't, and so they don't size or position their strategies, their credit spreads, according to volatility, or they have no concept of the idea of premium decay rate. So they just tried to put something on based on delta. And so while it is rules executable, they're usually going by the wrong rule. And is it repeatable? Repeatable is scalable, definitely off the table. These are not things that, sure, you can do it every day, but you're going to get different results, and you're going to wonder why. Some days they seem great, and other days they are just a bear. All right, let's go on to the next. Iron condors. This is the one that most people are trading. They'll put on an iron condor. They'll set the delta of the wings at 10, 20, maybe 15 if they're a little bit more aggressive. And that means that if they're setting delta at 10, they're looking at a 90% win rate or 90% probability of profit. And of course, that is conditional upon price staying right where it is in the middle and not really having any kind of move. Now, of course, markets move, and as soon as it moves, that whole profit equation goes out the window. And on top of that, with that extreme risk to reward, large risk, small reward, you have a lot of a lot of gamma in your profit curve, a lot of steepness. So as soon as your market starts moving, you're underwater almost immediately. And this is why most people in iron condors are setting their profit target at 50% of the available premium. Now, that's not a 50% return. That is actually about a 5% return on their profit, because you have to take into consideration your return is really relative to the amount of risk that you're putting on. So if you put on a trade for $900 and you're going for a $50 profit, that's pretty meager. It's about 4.5% return. Now, if you get lucky and you can get the entire win, sure, you've made, 10% or 11%. That's not a great return, 11% on your risk. So there is no real asymmetric payoff. This results in a left-skewed long-tail distribution. In other words, you make a lot of tiny little wins, and we'll look at this a little later on, and a few small losses, some medium losses, and some very big losses. That risk that you put on, no matter how much you say that you're going to adhere to your stop losses, those stop losses are going to hit you a lot, effectively giving you a much lower probability of profit. And every once in a while, you're going to experience, and I know you all have, because you've got this idea in your head that you can roll out of one of these trades and extend the time or extend your profitability. But all you're really doing is accepting a loss and putting on more risk. So they're not repeatable and they're not scalable. It's really one of the worst ways to trade zero DTE. Yet it's the one way that most people are attracted to. Go figure. All right, let's look at naked options like selling puts. There is no defined risk. You have unlimited risk. There is no asymmetric payoff. It is essentially a high probability strategy. So you're getting very tiny return for a humongous risk. Is it rules executable? Not really. Most people aren't looking at volatility when they're putting these trades on at all. They're simply looking at delta. And that's really the crux of it here. Most people think that delta is their go-to criteria when it's not. It should be the available profit available to you versus the risk that you put up, not just some arbitrary win rate that you think that you're going to get, because as soon as the price starts moving against you, you're underwater. And sure, you can roll, but rolling, again, is nothing more than defeat. You're accepting defeat and extending more risk. So get that out of your head that rolling somehow is your magic bullet. It's not. And it's definitely not scalable. All right. And as I said, gamma scalping, hold a long straddle or a long gamma position, trade the underlying back and forth as price moves. This is basically scalping little bits of premium as the day goes on. The problem with this is that you have to do this dozens or even hundreds of times in the course of a day, and your commissions and fees are going to start piling up. Your ability to actually scalp those is going to be limited to pennies on the dollar. So it's definitely not an asymmetric payoff. It is not rules executable. It's really get in there and just fight the market. Now, institutions can do this because they have the kind of capital outlay that they need, and they have the execution, the automation that they have to do this. And they're not being charged commissions, so that they can scalp pennies at a time and make something out of it. But for the average retail trader, this is really a no-go. All right, so let's take a look at all of these according to our criteria. Lotto calls, all right, you win on two different categories, defined risk, asymmetric payoff, but loses everywhere else. Credit spreads, pretty much the same thing. Iron condors, very similar to credit spreads. Naked options and gamma scalping. I know a lot of people think that they can do well on naked options, and as a matter of fact, I met somebody at a conference not too long ago that was talking about how they're selling puts and how great it is. And in the same breath, they're talking about this one position that they've had on for several days and they can't get out and it keeps on going against them. And now they're like $6,000-$7,000 underwater and they don't know what to do. And it would, if they were to roll, it would take them literally a year just to get out of that position. When the reality is they had to just accept the loss and they didn't want to do that. So in their mind, they're still in the game, right? And that's the fallacy of all of these types of things. They fool you either with some other thing that, hey, you can keep on rolling out of a position, or you can put on a high win rate and ignore the fact that you're taking huge risk that is inevitable that you're going to handle it. And they're not scalable. You can't compound with any of these strategies. That's the simple fact. Okay, so let's go on to what we do. What we do is the out-of-the-money butterfly. We are putting, and this is, just so you know, the structure is to put it either well above the market price at the money or well below. So above it, we'll put on a long call fly. Below it, we'll put a long put fly. And we typically trade with the trend. We are adjusting the width of our fly to accommodate the volatility regime, because under different conditions, we're going to have different rates of premium decay and different profitability available to us. And our goal is to keep a consistent risk-adjusted approach to this so that we're always going after the same amount of money for the same amount of risk that we put on. We don't want that to be flying all over the place out of our control. And we're putting on defined risk. So our risk is super small. So instead of taking huge risk for tiny profit, we're taking small risk for a large potential profit. Okay? So everything about this is the opposite of all the other ways of out-of-the-money trading, zero DTE trading. The out-of-the-money butterfly is really the only one that ticks all 5 boxes, and we'll see that next. You have defined risk. The debit is the max loss. That's the most we can ever lose, known as our entry. It has asymmetric payoff. At the very most, we use what's called the 10% debit rule. We have a 1 to 9 risk to reward. Sometimes we can put on a 1 to 15 or 1 to 20, even a 1 to 30 risk to reward. That might sound like a lotto play to you, but if price moves in our direction, we have extreme payoff for the amount of money that we put up for that trade. Our returns aren't like 4.5%, 5%, maybe 10% like the iron condor. No, instead, our minimum payoff is usually 25 to 50%, but more typically 150, 200, 400%, sometimes as much as 1,500% return on a single trade. Is it rules executable? Absolutely. Everything about what we do, we know before we even enter the market. We set up prior to the market. As a matter of fact, I talked about this in yesterday's episode, that we have our analysis, our preparation in the beginning part of the market where we're looking at the volatility regime, the directional bias, and the structural levels where we'll have an event. So before the market even opens, I already know where I'm going to be taking this trade. I'm just waiting for that event to occur. Is it repeatable? Absolutely. Works in any direction, any market, any volatility regime. Doesn't matter. Most of the efficacy around this trade is trading it in the morning session because that's where the most volatility is. But we do have strategies where you can trade it any part of the session for various purposes. If it's a Fed day, we wait until the Fed is about to speak, and then we'll put the trade on. So that would happen in the afternoon. Or gamma scalping, we can do those later in the day. So it's very repeatable, and it's scalable. It's scalable because our payoff curve is right-skewed long-tail distribution, a positive distribution, meaning our risks are always capped. Yeah, we make a lot of small little losses, but we have small wins, medium wins, and huge winners. You never have medium wins or huge winners in the other way of trading. It's always the other side. It is a left-skewed distribution. We'll take a look at what that looks like. So this is a high win rate strategy on your left, showing mu is the median, showing that, yeah, you have a lot of little wins, right? but you also have these medium and long tail huge losers that destroy you. And of course, everybody that has traded these types of strategies know that, yeah, you get on a run and you're making all these small little wins, and then bam, you have one big loser or maybe even two big losers that wipe out weeks of your wins and set you back in time every time. And this is why people trading these zero DTE strategies can never compound, ever. It'll just never happen. The math is against you. Where what we do, the asymmetric strategy, it's a lower win rate. However, our losses are always capped. They're always small. Here's mu, a bunch of small losses. But we get small wins, medium wins, and huge winners. And this results in essentially a stair-step equity curve. I showed this yesterday, where we're most of the time playing for a tie. And then when the big winners come, they elevate our account. The problem is that there's not the problem. The benefit is that there's never a big loss, ever. Ernie, I work full time. I can check a market a few times a day. Is your trading method compatible full-time employment? Is this more of a day trading strategy? So what I'm describing today is zero DTE, but our strategy also extends out to multiple days as well. We have many different campaigns that we run. One that we call the convex stack, that's 3 to 5 days out, and then the sigma drift, that's 5 to 10. And then we have other strategies that go even further that don't require you to be watching the market all day. You can just check in on it when you want and then take your opportunistic profit. So it's the same exact concept, just applied to longer dated needs or lifestyles. And a lot of our traders will trade a combination of all of these. They'll trade the zero DTE and all the longer dated ones as well. We also have overnight trades that can often accommodate someone like yourself that is working full time, where you only have maybe time to peer in maybe a couple times a day. So yeah, it will accommodate just about any kind of lifestyle. You don't need to trade zero DTE. You can trade basically the same strategies. In fact, that's how I trade stocks and things like that don't have that don't expire every day of the week. So sometimes you put on like a Tesla trade, I'll put it on a Monday, and I'll just wait throughout the week until it falls into profitability, and then I'll take the trade off. And if it makes it all the way to Friday, that's great. Then you get the big payoff. All right, there's a question on noon. It says, would you have a session on your multiple campaigns and results? Would you have a session? On the multiple day ones, there are some that benefit by placing your strategy according to structure. So yeah, but some of them are far enough out that it really doesn't matter. You're just looking for a convex setup. That means a price where the rate of change of the price of that setup has changed dramatically in your favor, giving you a really attractive payoff curve for much less money. That's typically what will happen there on your longer dated ones. All right. Why every sacrifice compounds against you? See, the thing is, when you're taking extraordinary risk to make a tiny little bit of money, in your trading account, while you might have those high probability wins that are coming in, tiny little wins that are slowly accumulating, it's inevitable that you're going to have a much larger loss compared to those wins. And whether it's something that you stopped out, or maybe you missed a stop, or you decided to roll, those losses compared to your wins are often 10, 15 times the size of those wins. And so that creates huge volatility or huge peaks and troughs in your trading account. That is antithetical to everything about compounding. In order to compound, you need to have steady growth forever and never draw down. Our strategy is designed specifically for very small drawdowns. In fact, over the course of the past 3 years, my drawdown has never exceeded 6% of my total trading capital. Most of the time, it's within 2%. Now, most pro traders have a gold standard of staying within 10%. Most retail traders routinely will go and have a drawdown of 20, 30, 50%, and often 100%. When you start drawing down that much, getting back to your original high and trying to make a new high is extremely difficult, if not impossible. And also, it puts you in the wrong mindset. You're trading behind the gun. You're making bad, illogical, irrational decisions. You're panicked. Anxiety is always part of your game. In fact, that's the whole thing about high win rate strategies. Your number one goal is to manage your risk. And that's all you're ever doing is managing your risk. On our strategy, we never manage our risk. It's already taken care of because it's a defined risk. Our losses, we let them go 100% because they can't hurt us, even if we have dozens of them in a row, which is very unlikely, but I'm just saying, even if that happens, it's not going to be enough to draw us down any appreciable amount where any one or two wins can bring us back up to a new high. So we never get hurt on the downside. And instead of managing risk, we're managing profit. So you can see it's a completely different mindset, right? And we don't have to be right on direction. We are not trying to predict direction. Even though we trade with the trend, that doesn't mean that we're trying to go long or think that we're going to go long one day or not. We could be long and have a trade go against us and still make money on that day, right? So it doesn't matter. The only reason we trade with the trend is to take advantage of those few times when the average move really moves at a greater magnitude than the counter trend moves and gets deeper into our trading structure. Now, that happens every once in a while. It's a small edge, but trading with the trend is definitely an edge. It's not a strategy that's saying I'm trying to predict where the market's going. In fact, we don't predict. We only position. It takes all of that stress off of you. So, and I already talked about one day takes it all. Strategies that pay small premiums against open-ended risk will be solvent until they aren't. In other words, you're doing those nice little wins and they are great until you get the big loss and wipe them all out. The destination is not there. One tail event ends the experiment. So that's what it really comes down to. If you want a strategy that looks like, here, I'm going to show you an example of my actual trading performance in my Discord. Let me see if I can get to it here. There we go. So this is my trading account. These are the trades that I've taken inside the service. All of these are documented directly from my Fidelity account or my Thinkorswim account in there. These are all trades that are taken. This is including full commissions and fees, everything. And this is the type of performance. Now look, I want you to look at the win rate, 52.6%. I am not winning all the time, yet I have this kind of performance. The drawdowns are super small most of the time, under 2%. My max drawdown was a one-time event. I got down to 6%, immediately recovered. When I start drawing down, I start mitigating the chance of going down any further. That was Siri. And my average risk to reward is 1 to 9, almost 1 to 10, and a Sharpe ratio of 4. You'll probably never see that in any retail account. That's more Renaissance Capital type of Sharpe ratio. All right. And so that's what it really takes. And you can see it's a stair step. I go up, sideways, up, sideways, up, sideways. Right? So just pointing it out. Up, sideways, up, sideways, up, stair step the whole way. That is the nature of this trading. Right? All right. Let's get back to Coach. All right. So there it is in black and white and the math behind it. The out of the money strategy, the low win rate, the extreme asymmetry, small risk, large potential reward, looking for convexity, being able to adjust our trade according to the volatility regime in the market. We position, we don't try to predict. All of those things are a professional way of trading. They result in these kinds of returns. So long term, you're consistently profitable. You understand exactly why you're making a profit and where your edge is because the math is right in front of you. So you become an independent trader. And then we'll show you how to do this consistently and develop a continuous improvement process. In fact, yesterday's show was all on that. We showed you when you join our service, you get 4 weeks. And in 4 weeks, you're going to go through 3 to 4 of these cycles. And you're going to learn how to develop an excellent daily routine and a weekly routine that will close the loop. And you'll have up to 3 of those weekly routines that will show you whether you're making progress or not. And then how to adjust yourself so that you can continue making progress. And you'll be on your way to becoming consistently profitable, independent, and trade at a pro level. That's what it's all about. Let's see. Is that one? I don't know what that question is. It's hard to see. Is that one car cat? My glasses aren't that good. But in any event, thank you all very much for showing up. I really appreciate it. If you like this content, please give it a thumbs up. Share this video with your friends. Tomorrow we're going to talk about the details of getting in and doing profit management on these strategies. Would you have a session on your multiple campaigns and results? See, I'm not sure exactly what that means, but all of our stuff, when you get into our Discord as a trial member, you'll be able to see everybody else's trades. Everyone records their trades. You'll be able to go back into 5 years of data and see what we've been doing over the long term. Hundreds of traders in there, all trading this strategy, successful. Some people are just starting out so that they're getting their routine under their belt. But you join that, and eventually you'll be able to be part of that crew making consistent profits. I think the person said one contract. Oh, I see. Oh, a car equals contract. I get it. Yeah. Depending on your account size, the size of your position is going to be directly related to the kind of drawdown that you're trying to achieve. So with my account, I have 2 accounts that I'm using. One that's about a little over 100,000, another one that's over 500,000. I'm trading somewhere around 0.6% to as little as 0.3% of my total trading capital on any trading session. So that, however much money that comes out to, that might be 1, 2, 3 different positions. But usually very small like that. And can I show you the Discord? Yeah. Let's see. Where's my... Somehow I clicked on somebody's comment and it brought it up there. Add to broadcast. Yeah. How do you get rid of it? Remove it. Remove from the broadcast. There we go. All right. I'll show the Discord. This is our Fat Tail Discord. We have a talk channel. People put their trades in here. We have a lounge. We have coach calls, our video archive, all of our daily live streams that happen every day from 11 a.m. to 12:30 are all recorded here, and you have the back history. You have availability to the old Discord, which has 5 years of data, and you'll be able to go back as long as you want to check out what we've done there. There's a tremendous amount of information in there. All right. And also we have courseware. Let's see if I can bring that on. Courses. Safari. So we have our courses here. These are full-fledged professional courses that go over all aspects of our trading. By the way, we're changing from fly in the wall to fat tail. So a lot of this is going to change its look, but the courseware is complete. It would take you probably a couple of weeks to go through all of these courses. All right. So there you go. Everything's included. When you're a trial member, it's a paid trial, but when you're a trial member, you get all the same access to the full coaching, the Discord, the live streams, the courseware, everything are all available to you. All right. And if you want to get there, I'll put the link should be down in the description. It's fattail.ai/try, and that's where you can join. All righty. There you go. That's it. Tomorrow we have another great show. So hopefully we'll see you then. Thank you very much, and have a great day. Peace.